All right, gang. So today we're going to cover volatility. What is volatility? Volatility is how we actually measure the price fluctuation of a stock. Okay. So we're not looking at direction up or down. It's just actually the amount of action that's in that stock. So action is a good word to describe volatility. How much action is in the stock, right? So high volatile stocks, they have a lot of action. So when you're looking at the charts, you'll see the price is fluctuating, a lot of big moves, right? And when the volatility is low, it's low action. So the stock price is not fluctuating as much. If I just take a look here at the chart, we're still looking at Apple here. Let me actually show you low volatility here. Let's just go with a stock that's normally pretty consistent, Microsoft. All right. So Microsoft, you see the candles from the left to the right, they're pretty stable. And as volatility hit, we had this, stock market correction here from the crash. So that is embedded throughout pretty much the entire market. But before that move, its normal distribution is pretty stable. Okay. So that's low volatility, right? If you take a look at like lots of pharmaceutical companies, they are high volatile stocks. You see all the strong ups and downs, the whips, these are high volatile stocks. Okay. That's just the natural behavior of certain stocks. These are like individuals, right? So their normal movement, how they normally behave. When you look at the charts, you can kind of see that, right? And so the thing when it comes to the options world, let me actually take us back to Apple. When it comes to the options world, we're trading the same stocks that stock traders are trading, right? But stock traders are just looking at price action. Options traders, we have access to statistics that stock traders are not taking a look at here. So we can see the price action the same way they do, but we also have to factor in volatility, which helps us to project in the future. Okay. So if we go back to the options chain, let's go to the trade tab. And when you go to the options chain, let me just minimize this. In the options chain, we can look to the right side here. And this tab right here says implied volatility. So this gives us a sense of implied volatility, which implied volatility is what the markets are expecting, the price range that the market is expecting the underlying stock to move. It's not, in a direction, it's either direction, but it's still the movement. What's the excitement or the action of that movement? Okay. And so we think about that in terms of the implied volatility. So this is actually what the markets are expecting the stock to actually move. And how are they coming up? How are they deriving this figure? Is basically we have access to a lot of data. We know that stocks have earnings that they report. We already have that on the calendar. So the market makers are already factoring in earnings. And in the case of Apple, they may be factoring in, they have a new phone that they're actually going to be releasing. They normally release new phones, I guess, twice a year or so. So that's already priced in. If there's lawsuits, court cases, other things that's, happening in the macro where you have Fed's interest rates, changing, or if they're moving up or down, all these different factors is what's helping the market makers to price, in the volatility here. So we call that implied volatility. Now, there's another volatility called historical volatility, which is when we take a look in the past, how has the stock acted in the past, right? And so we'll take a look at that there when I take you guys to the chart so you can see that. But what I want to show you right now is why the volatility is important, because it contributes to the pricing of the options itself. So we go here to the May 15th contracts. Let's just open that up real quick. And we have our Theo price mark layout here. I'm just going to show you what happens. And this is important because a lot of new traders, they get ate up on this because in options, you can get the direction right and still lose money if you didn't get the volatility correct. So volatility is going to help us to determine the appropriate strategy. Once we can identify the volatility, then we can actually go into our strategy selection. So this is very, very important that you get it. But I want you to see it, how it works. So what I'm going to do is go here and just give you some theoretical pricing here. Let's just make the stock price at 0. So that means that if we're speculating that if the stock price doesn't move at all, let me go to today. Okay. Stock price doesn't move at all, but the volatility changes. Okay. Here on the Theo price, right here on the side, And let's just take a look at the money strike, which is 280 strike. And we see it's at 1577, somewhere around there. So I'm going to actually slowly increase the volatility. And you're going to just take a look here at how the pricing of the options contracts are increasing. Okay. So this is if the stock price doesn't move. This is pricing direction, not moving, but volatility moves on its own. It has a major impact on the prices of the contracts, right? So as volatility goes up, the prices go up. Okay. It's more volatile. So the options contracts are more expensive. It's the same way, like we talk about the preseason games. Not that many people care about the preseason games. The athletes are not even performing at their highest level. Nobody really cares. So those tickets at a preseason game are going to be cheaper than if you're catching a game at the finals. The finals, I mean, it's going to be action-packed, dynamite. Everybody, their mother's watching. The players are playing at the highest level that they ever played throughout the whole entire year. The tickets are going to be very expensive, okay? So the higher the volatility, the more expensive the options contracts are going to be. And then the lower the volatility, so if we go in here and we lower the volatility, let's just make it negative 10, then we'll see that the prices at the money strike have dropped significantly, right? And so even if the stock price goes up, let me take the price up, right? So even if the price is going up, let me just take it up more. All right, $2, it's still less than the bid and the ask, right? Because the volatility impact of the pricing matters, okay? So we got to understand the volatility, right? So that is the implied volatility, how it actually works, and it's major, okay? So what I want to do is show you how we can actually determine each individual stock. So every stock has like a personality, right? So when I was just showing you guys the different stocks there, right? They have personalities, right? Kind of like you have a friend that is, I used to have a friend that was basically routine. Every day he would get up and do the same thing every day. And when he came home from work, he would do the same exact thing. We know exactly what he would do at the same time every day. This is, my younger days with my roommates. And so he was predictable, right? But I have this other friend, and we all roommate together. Our other friend, he's very volatile, okay? He would come home 3 o'clock in the morning from the club, and he would be just irate. He'd just be crazy, right? So that was my volatile friend. Then my other friend, he was my low volatile friend, right? Because I can predict him. I can see his movement. I can predict how he's going to move. With the other guy, you just didn't know what you're going to get. So I'm sure you probably got some of those people on your friend list. But those are high volatile people. Same way that the stocks work, they have their personalities. So when I showed you the Microsoft, that is a generally low volatile stock versus Pfizer, which is a pharmaceutical company that's more of a high volatile company, right? And so that's how they normally behave. But the implied volatility is what the markets are expecting for it to move. And what we want to do is gauge how it historically behaves in the past. We're taking past things that we know, and then we're going to actually combine that with the implied, and then we're going to actually subtract those out, okay? And the remaining balance is going to let us know, if the volatility is high or if it's low. So we're going to go to the stock chart here, and I'm going to show you guys how to you can do this in different ways. And then we'll go to the options chain. I'll show you how you can easily find this out. Actually, let's go to the options chain right now. Okay, let's just go there right now. So go to the options chain on the trade tab. And if we scroll down, okay, I can just close the options chain for a moment. We can see today's option statistics. Okay, this makes it really simple. And then you will see the current IV percentile, 35% here. And then you see current HV percentile, 56%. Okay, so HV is historical volatility, and IV is the implied volatility. Okay, and so what we actually want to do is simple. We just want to see if the implied volatility is higher or lower than its historical volatility. Now, if the implied volatility is lower than the historical volatility, then it is in low volatile state. Okay, and if the implied volatility is higher than the historical volatility, then it's at a high volatile state. Okay, and so once we identify if the volatility is low or if it's high, then we can get into our trading strategy selection, whether we want to enter in our position as a buyer and whether we want to enter in as a seller. The concept is still the same. We still buy low, sell high. The order could change, okay? We can begin as a seller or we can begin as a buyer. That's different. It's the same thing, it's just different order. The key is that when the volatility is high, we want to sell. And then when the volatility is low, we want to buy. And buying and selling can be bullish or bearish, okay? Not to confuse you, but just understand when we get into the strategy selection, I'm going to explain it to you more. But just understand the key is still buy low, sell high. So when volatility is high, our strategy that we're going to begin is going to be a seller. When the volatility is low, we actually want to enter in as a buyer. And we'll make money as the volatility rise, as I just showed you guys in the theoretical pricing. So now let's actually go to the charts here. And I want to show you, and I'm going to give you guys a tool here as well. Let's just go to a daily chart. And we're going to go to our studies, and we're going to add study. Let's go to edit studies. And we're going to put in HV, historical. We're going to put in historical volatility. And we're going to add that to the chart. And then we're going to put in IV. Let's see, or implied. Where is it? Here we go. Put in IMP and you get implied volatility. That'll show up. And then we're going to enter, add, select that. We're going to put this in a chart. We're going to hit apply. We'll hit OK. Okay. So if you take a look, and you can do this once you get this on your chart, you want to put it on your daily studies, basically. And you can put in any stock ticker that you want, and you can actually gauge the level of volatility here. At the top is historical volatility. We can see here it's telling me, and I'm going to expand this as I lift this up so you can see it better. It's telling us here the level of the volatility, and then you'll see the end number. You see that little bubble there, that purple one. It's telling us right there, 65%. And then the bottom one is the implied volatility. It's at 47, right? And it's the green line that we have down here. Okay. And you can change the colors on these here if you like. We can get real snazzy with that. You just go here, hit edit study, and then we'll go change the color. Let's go with this. Let's go with this red color. I think red signifies volatility for me. And then we can leave the historical volatility at purple, right? Some more neutral color. And what I want to do here is go back to our studies, edit studies. And then all you need to do is you can just click this arrow up. So we're going to slide the lower band into this historical volatility. So we're going to combine the two. Bingo. So once we combine the two, hit OK. And there you go. You just created a little indicator as a volatility indicator. And what you can see here is that our implied volatility is lower than our historical volatility, right? So as I am scouting through stocks and I'm looking for setups, right, it's more convenient for you to be able to just look at the chart and be able to tell if the volatility is low versus you having to pull up the chart, then have to switch over to the trade tab. We want to have it right there on the chart so that we know, when we see our setups, we can see the price action, and we want to make a move based off of direction or what have you. But then we also want to factor in the volatility. As soon as I look at this chart, I already know what I need to do. I already know I need to enter in as a buyer, right? Because I can see that the volatility, historical volatility is higher than the implied volatility, okay? So we can see that there. I got another cool indicator that I want to give you guys. And what you'll do here, the link should be included in the class, so you'll see that in your materials. But when you enter your platform, you hit Setup tab, and you'll be able to hit Open Shared Item. So you'll copy that link and hit. You'll enter it to this screen here, and then you'll hit Control and V. You can't copy and paste from your mouse; it will not accept it. But if you hit Control V, it'll enter it in here for you, and then you can preview it. Then you can hit Open and save it to your platform, so therefore you'll be able to see it. I already have it here for you guys, so it wouldn't, I'm not gonna be able to do it that way right now. So once yours is in, then you'll be able to access it from Edit Studies, and you just find the name of it. It should be WSJB for Wall Street Jap Boys Ivy Rank, and then I'll just hit Add Selected, and then I'm going to hit Apply, and bingo. you'll see it right here at the top left corner. This is the IV percentile. And this is the way when you guys see me on my live account, this is what I'm using, okay? This just helps me to identify it quickly in a snapshot. It's color-coded, has the numbers there. We have larger time frames and smaller time frames. So if I want to get in on some day trades, I can use the other ones to the right, the medium and the small one. The large one is the one that you want to focus on when you look at this, so you can just quickly slide through certain charts, and it'll quickly just be right there in the corner, right? So if you don't have space on your chart, you don't want to have your chart with a bunch of lines and things like that, you can remove this studies down here at the bottom, and you can just use this one here. Now, it's not as accurate as what the statistics are showing, because this indicator here is actually removing gap up days, basically. So it gives us more smoother data. But overall, it's pretty it's accurate for what we need. So we want to know, are we buying or we selling, basically, right? Is the volatility low, is it high? All right, so this is where you look at it on the stock chart. So again, that we have volatility, which is the action. Historical volatility is the past action, how the stock normally behaves in the past. We've seen that. We've already measured that. The implied volatility is a look into the future. What is the market makers? What are they expecting for this thing to move? We're actually taking a look at the relationship between the implied volatility and historical volatility to guide our decisions on our strategy selection. So there you guys have it, volatility. Hope you find this useful. Catch you in the next class. Peace.